Welcome to Power Charting. Today, Wyckoff Distribution Watch. Is distribution underway? This is one of the really hot topics right now in the Wyckoff community. And so let's really tackle this and then ask the question, contrary to that, can the market rally from here? Hi, I'm Bruce Fraser. I'm your host. Welcome to Power Charting. Well, let's start with a distribution review. We're going to go back over some studies that we've done over the last couple of months here together, and then ask the question, are we in distribution? How far along are we? What are the telltale signs that it's about done? And recall that distribution ultimately turns to markdown, and the markdown is where the severe price damage is done in stocks, in markets. Have just a real brief comment on Fed and crude oil. And then at the end, given time, we'll talk a little bit about some portfolio risk management technique, some rules of thumb to help us all be a little safer if in fact distribution does go to markdown. And here you can see, here are two distribution schematics. We've talked about them in the past. And so the one on the left is the distinction here is the upthrust after distribution with a final upthrusting action above the area of resistance with an attempt to rally up and away from the distribution area, which then fails back to support, through support, has a test or a series of tests, and then goes into a markdown through the distribution trading range with last points of supplies that form on their way down to support, which ultimately becomes the all-important markdown. Over here we have distribution schematic 2, where the last point of supply comes late in the cycle, in contrast to the upthrust after distribution. And then this is what precedes, it's the last rally, precedes the series of declines with shallow rallies on the way to the bottom of the distribution area, and then again also into markdown. Read more about this in my blog from 2015. So with that in mind, also please note that these references here are to prior power charting episodes where we did in fact talk about these concepts and review them, so that if you care to, you can go back and see what we did at that time. So, and before we start on this chart, I'd like to take you to an announcement. Roman Bogomazov is starting his new class cycle in the fall. It's outstanding. You're going to want to attend. The first episode is always free, and this is the Wyckoff Trading Course Part 1. First session free, wyckoffanalytics.com. And then also he does a tape reading lab, and that is going to have an open door session on August 25th. And you can see that also that episode for free. And then he and I do a weekly market discussion where we talk about these very topics, among other things. And this discussion, we are going to have a free episode September 1st, register for free. And to make it easy for you, go to the Power Charting YouTube description page, and I will have links for all three of these there. And so check it out. I think that if you're a real Wyckoff lover, you are going to enjoy these courses. Also coming up, TSAASF, the not-for-profit, educationally oriented Technical Securities Analysts Association of San Francisco, TSAASF.org is going to have a virtual fall conference, second year in a row. We always hold it in September. We have a great list of speakers, and you can go sign up now for this. Sign up is free for members, and so become a member. It's very reasonably priced. And then also another member event is going to be Jeffrey Huge, CMT, is going to speak on September 2nd. So that will be how to construct a portfolio that consistently generates positive alpha, and should be a great session. So please come join us. All right, let's get to work. Here, Dow Jones Industrial Average. This is with a distribution analysis on what has happened here. I have entertained the idea of this being reaccumulation, and potentially it still could be. So the key we want to do is to align this to the distribution schematic with an upthrusting action, because as you can see, there was an attempt for the Dow Jones to rally up and out of the resistance area and above this buying climax peak right here after becoming range bound with a buying climax automatic reaction since early May, long period of time. Big causes built. So now we can see here that there is an attempt to come back into the trading range area after jumping out. So is this a test? Is this a backup and a test? Very possible that it is. At the time, we showed that it was an attempt to emerge from the danger zone when it rallied up, paused, and then rallied again. Now it's having a rather sharp reaction. Here's the thing about the upthrust after distribution, is that as you can see from this schematic, is that when after the upthrust you get a test, and then it starts to just melt its way right back through all of the prior resistance areas, which are now support, and it moves really easily, effortlessly, wide range, expanding volume as it goes down, because of the very title of this type of structure, upthrust after distribution. That means that distribution has already taken place. Stock is transferred from strong to weak hands, and so the downtrend can begin. It can go steadily and really seemingly effortlessly downward. And so this is going to be the thing that we will look for, is the ability of not only the Dow Jones, but other indexes to move really easily back down to the support area, which is around 33,500, the area of the low of the automatic reaction. And so if we see that, that'll be a huge clue that that is exactly what this structure is. And so we will want to become defensive. We'll talk about that at the end of the program. If I will just go a little faster here, I want to show you again, this is from a prior video, and here is a 15-minute Nasdaq 100 point and figure chart, and this area with the gold line, this count structure here, which goes across, counts up to this area 15,040 to 15,197.75. Well, look where we went. 15,184.27, which was the high print made on August 5th. So really a good count, worked well. Look at how beautifully this signaled an important rally phase coming, big jump up and out, and this count line is at 13,138. Wow, point and figure is great stuff. And so we'll just keep doing lots of point and figure here. But anyway, and also look at how this distribution here worked out so well also. So here we are fulfilled. Now, does that mean that the bull market is over? No, not at all. As a matter of fact, this is an accumulation area that formed in about 2 to 3 short weeks in May. And so upward it went, and now we could have another reaccumulation form for a few weeks and give us another really dramatic upward count. Too early to tell. Now, in the case of the S&P, look at this. This is from May 12th, and they throw over up here of this upper reverse use of trend lines. Solid line is reverse use. That's the way I do it anyway. So that count, which I put this here because this is the highest count we've gotten to, but this upward stride that has been in place since November has been reacted here sharply back down to the bottom of the range, which we will look for buying opportunities when we get into an oversold condition like that. And so that occurred right around the area of this count. Well, this count was exceeded, as we see here, from the 4480. Now here is a chart that is up to date. And so you can see that this is where the 4480 is. And again, another overbought condition. This was the area in here. This was May. And so this was the area of the prior chart that we looked at. Now, again, here you can see downward we go. Look where we're at now. Let's blow this up real quick so you can see it have gone down, touched this lower demand line, oversold condition, but possibly could go through it, attempting to bounce right now. And so we will again look at some other evidence that might tell us whether or not there is the potential to rally up back to the top of the channel here pretty soon. This could be a distributional structure here. So buying climax, automatic reaction, or maybe this is the buying climax, but this could be distribution here. And then a very sharp break, the kind of break we'd see on an upthrust after distribution. So talk about crude oil for a minute, especially regarding the Fed. Fed's been under a lot of pressure because of just the sheer incredible inflation bulge that we've had in 2021, which we have talked about in this program over the last number of months. Now, crude oil has corrected from around the $78 area, just under $78, and is now at 65. This takes a lot of pressure off the Fed. And so the Fed, who said that they may begin to taper at the end of this year, well, this could in fact maybe cause them to soften their language about their strategy. And so the talk is that the market has reacted here and has been weak because of some of the Fed comments. Well, I'm not saying this could happen right away, but potentially the Fed could soften their language just because crude oil has such a powerful impact on the inflation rate through all parts of the economy. So we will just it'll take time for us to see. Now here I did a little point figure count. Here was a count that was back prior to this time period back. This is like March, April, May, counts up to 72 to 75. This count here counts to 66 to 64. We're very close to that count now. The count could be made larger potentially, which would get us down to about 59. So just an interesting place. Finally, not finally for the program, but I want to just again remind you about a chart we've looked at over time, the decennial pattern. We've looked at this. This is we are in the 1 year, 2021, and we see a peak that comes in around mid-year. Here we are in August, and then we tend to have a downward trend into the end of the 1 year, a rally in part of the 2 year, and then another lower low. So that would be sort of a macro cyclic reason that the market may be in need of some kind of a larger correction. So hang on just a second and we'll be right back. Here we're looking at the bullish percent index of the New York Stock Exchange. Top chart, bottom chart is the New York index. So this is all stocks on the New York. And so down here you can see that this is a video. This is a chart from a July video, but at the time we were pointing out, this has been brought up to date here, but we were pointing out that there has been a downward series of lower highs in the New York Composite bullish percent, and that this started to really fall off starting in July and into August. And so now this number being above 50% is not alarming by any stretch in my mind, because as long as you have more than half the stocks in the exchange on a bullish percent buy signal, that to me is a solid underlying technical environment. Here you can see that there's something that looks a little bit like it could be a distributional type structure that has formed. We will in a minute look closer at that, but the thing that we would want to do is to see here, you can see a rally attempt here and here, which have produced upward trends in the New York comp. And so we would like to see a stabilization here and then an attempt to go up. Also, you can see that here. And this is the COVID January, February peak. And look at how you had just the briefest of time spent diverging from a high to a lower high into a downtrend. We don't have anything like that going now. Now it's just sort of a slow deterioration, which happens in mature bull markets. Many stocks and groups will fall by the wayside, and there will be fewer and fewer that tend to lead the way. Not uncommon. We're seeing the effects of that now. But here is a point and figure chart done by my teaching partner, Roman Bogomazov. And so I want to just, for the time being here, focus on the COVID low. This is the COVID base back. This is 2021 into the end of the basing period, and look at the count that we had. This is futures, not cash, but you can see that the actual high that we've recently reached is 15,172. 15,400 was the count of this large structure here. And this is very close. So we are within a couple of boxes of fulfilling this minimal count at 15,400. And so we're on alert that we have used up the large amount of fuel that formed in a short period of time for the Nasdaq 100. And so let's just keep that in mind. Now here is the S&P 500 point and figure. 4480 again, I think we talked about that, was the count. Here you can see that 4377 is the count of this area across here. So this zone. So we have overthrown the 4377. So that happens often in point figure. And then what we often see on a fulfilled count, now this is 30-minute point and figure data, is that after a throwover, if it comes back in to the 4377, 78, 4378 area very quickly, then that's a sign that that count had efficacy. So we will be watching that closely. Here is a chart I've never shown before, and this is a very, very interesting chart. I'm not sure that I've ever talked about point and figure on percent box scaling. which is a form of logarithmic point and figure. And so I've sort of perfected the counting method as best as I can on this a while back. I've done a lot of work with Alessio on this, who is our Bitcoin expert. He's done a wonderful job with this tool and also increased the body of knowledge on it. But here you can see that this is a count that goes back to the end of 2018 low. And so this count across here, counting and then doing compounding, you have to compound these results upward. And so compounding this, look what happened. Each one of these boxes is 3% higher than the prior one on the way up. And so now we have rallied up to, in this case, as of August 13, when I did this, 44.66, let's call it, with a 45.8364 high reading and a 41.95 reading down here, here, and here. So we are right in the middle of that range. So this is interesting. Also, added bonus here is the fact that this is accelerating. Now remember, this is 3%. Every box increase is a 3% move, log scale. So this is very, very much a climactic type surge. Whether it can continue on, because it is pointing up right now, if it can continue on like this, the buying climax, if this in fact is what it is, we'll only know after an automatic reaction, will tell us an awful lot. But I'm watching this chart rather closely and I wanted you to see it. So I want our community to know about the cool stuff we're doing. So here in the case of the bullish percent of the Nasdaq 100, the Nasdaq 100, which is really 10 very important super mega stocks, trillion-dollar market capitalizations and up. Apple's about 2.5 trillion, huge companies. They are the tail that wags the dog. And so these very small number of stocks have been dominating the performance of the Nasdaq 100. Beautiful little base built here, reaccumulation, big markup. And in the case of the Nasdaq Composite, this is 100 stocks over here. This is all of the stocks in the Nasdaq Composite. Now, look at the bullish percent of the Nasdaq Composite. So the high was made in February, and this is the reason so many traders are finding it so frustrating to trade the market in 2021, is because these great growth stocks have really languished in 2021 since February. And this decline, now this was a chart that was made on July 15th. This was pointing just downward and was approaching the 50% level. So let's move on, running out of time. I might stay over a little bit. We'll close out right at the 29-minute mark, and then I may continue on, just finish some more of these charts. So I hope that that's okay. And so here, 240-minute Nasdaq Comp Index chart, you can see the really good rally from May onward. This is really just the 10 or so mega caps that have pushed this performance up like this. In the meantime, advanced decline oscillator, 5-period moving average. This is a 4-hour chart, but look, it just keeps going downward. This is diminishing. These are non-confirmations of the upward trend in the Nasdaq comp. So these are non-confirmation actions here. And then look what happened, right back down to the bottom. So this is very interesting. This is as of July. So bringing this up to date, you can see that this is now current. I have shown what's happened since. This has made no additional progress in the Nasdaq comp since that July period. So climactic climactic action, automatic reaction, range bound condition. This might be the climax here. This might be the automatic reaction. Seeing some people do really nice work on this. My hat is off to you folks that have been showing these valuations of this potential distribution. And so really nice job. And so here you can see downward we go. This is, I believe, this schematic number 2 over here, where a series now of last points of supply, ease of movement downward. Today's interesting because here we are on Thursday. Overnight, the market was very, very weak. And now today it's the comp and the 100 have rallied and are positive on the day, the last I looked. So I don't know for sure, but this model is working quite well in relationship. And then notice how after distribution, this markdown phase right here just moves easily and effortlessly. So what I think we need to see to confirm that in fact this is distribution is, because we still are in the middle of the structure, is we need to see a sign of weakness here, somewhere in here. And then a rally phase, and the rally needs to be of poor quality. So it could be that we get a decline, good oversold condition, and then start to have a more important rally that completes a reaccumulation structure. It's too early to tell. The point I would like to make here is that the market is oversold. And now look what's happening is that the Nasdaq AD oscillator is now attempting to rise. We've talked in the past about how when this indicator is rising, it is a directionality tool. And with the other thing we look for is positive confirmation at the lows. So we do have a rising indicator here from an oversold condition. It's attempting to go up. I think that is not a completely bullish condition, but it is an encouraging look for the potential to build a bigger base in here and then start to go up, and maybe we can get a good non-confirmation of the lows, and that would be very constructive. Also, I laid over the bullish percent on the comp here because I think it's worked so well. Okay, but about a minute left. Here's the New York comp with a zoom in July. I did a point and figure count that went down to 15,050, and now this is up to date. So you can see attempt to go down to the 50% level. And so here we are. This looks like an upthrust after distribution here. I put the schematic so that you could compare and contrast. And then here is a 1-box point and figure of the New York comp. Here is a 3-box. I just quickly counted a 3-box count here. Goes down to 14,500. So what has to happen is that a decline has to, now here's, look at this nice little sign of weakness. Now what has to happen is it has to go down here and then maybe consolidate. That will give us another sign of weakness, possibly an LPSY, and then that would show the potential for a completed distribution here. So things that need to happen, because look, we are oversold just below 50%, and now look, higher low, attempt to go up. So if this can consolidate here and start to rise, this could be very bullish. But here is the summation. We looked at this in July. We at that time pointed out that the summation was pointed down for the, in this case on the left is the New York Stock Exchange here. And then you can see it's pointing down. And then over here, this is the Nasdaq Composite, which was deeper. So you can, the deterioration here, as we talked about from February on, has been deeper for the Nasdaq Composite. Now this is the McClellan summation, and it was pointing downward and was at the 0 line. So again, this is a directionality tool. We focus on it for the direction that it's going. When it's turned up, we want to be bullish. When it's turned down, we want to be cautious. And so you can see how this works. I think it's a very good tool. And our good friend, Tom McClellan, keeps this indicator. And you can actually go look at it right on StockCharts.com and keep track of it. So here, this continues to go down, attempted to stabilize. Now it's going down again. And over here on the Nasdaq, it's even further along, and it's also downward, not ready to turn up. That keeps us cautious. Directionality is down right now, so that's important. Now, the ARK fund, we looked at this back in July. So this is the stocks above their 200-day on the Nasdaq index. So this is all of the Nasdaq stocks. And the point that I was making at the time, I'll make it again, is that this indicator was the yellow shaded box was showing that the percentage of stocks in the Nasdaq that were above their 200-day, a very good definition of an uptrend or a downtrend. So being above, the number of stocks had gone from 82% down to 50. And so no wonder it was hard. It's hard for traders in 2021 to be able to make money, because it's just the list of stocks that are rising is a diminishing list. So you can see that right here. But the paradox is, look at the Nasdaq 100 here. Nasdaq 100 has been rising dramatically. And we made the point at the time that this is all about the really big mega caps and how they've dominated the indexes. And they've also dominated the Nasdaq Composite too. Very, very large stocks. And so looking at the right, Nasdaq Composite percent of stocks above their 200, same chart as on the left. But below it, we put the ARK Innovation Fund. And Kathy Wood, great portfolio manager, has a great methodology, but she is subject to the trend changes of the overall market in these very volatile stocks. And so you can see, look at the correlation that exists between the stocks that are above their 200-day and the ARK fund's performance in the stock chart below. You can see that there's very much a correlation at the highs, the downtrends, the lows, and now the lower highs. And so this has really been a difficult environment for any manager that's operating in these in this space of the growth universe and these NASDAQ stocks. So just pointing that out, and also pointing out that this is the raw material or the environment that traders have to work in. Okay, so here is the ARK fund, and I'm showing the NASDAQ 1999 to 2000, and looking for a family resemblance between the final peak here in the NASDAQ comp back in 2000, and also in the growth stocks currently, and then what they did since. And this strips out the mega cap names out of the current situation. Doesn't throw them out because, say, for instance, Tesla's in the ARK fund, but as are some others, but they're not in the same market capitalization weighting. And so here you can see that this peak here might be the peak that we have here, or maybe this is it. But this, I think, is an analog that we should keep an eye on. And here's the ARK fund up to the present. So you can see the top chart is actually, this is the 50-day. So here, an attempt to make a low here. and an upward, maybe potentially a upward non-confirmation in the Nasdaq to the Nasdaq index itself. So go check that out. Okay, so now we're getting down to the last of our charts, which is here's the semiconductor ETF, and just pointing out on the right with labeling that the semiconductor ETF has some of the characteristics of a distributional top with an upthrust after distribution. Note the ability of the ETF to go back into the range of this trading range. And so now if this is a UTAD, and we would look for a decline in this area that would just persistently just walk down to the bottom. If it has the ability to be able to catch hold in here and then start to rally back above, then that would be very bullish, optimistic for the potential of this being a reaccumulation. But we now know the conditions that we expect to see to show completed distribution and also potential completed reaccumulation. And so note also that volume is expanding, but it is expanding. You can see here to here, the volume has diminished. So even though the volume is high and expanding, so volume off the peak, it is in a way diminishing from decline to decline. So that will be another thing we will watch closely. This is the Dow Jones again that we looked at earlier. Let me just zoom in here. So this is the reaccumulation count that we had done on a prior episode. And so this is a potential backup. Also, the Dow Jones has shown the ability to try to catch a low here. So we'll watch that very, very closely. And then let's go out, and I want to show you here that this is a trend channel study that goes back to 2011. Each one of these trend channels is in its own right a trend construction, which just happens to be parallel. So these two boxes here created the demand line. These two boxes created the overbought line. Throw over here at the end of 2017, overbought here at the end of 2019, and now we're throwing over the top. In each of these cases, it had to come back into the channel. So on this last bar that we have right in here, you can see that there's a tail, and this is the area that we are discussing possible distribution occurring. So if there is distribution and it can put the Dow Jones back below that trend line, that will be a very useful indication for us of the trend turning back into this large channel. And we will want to be respectful of the weakness that was created to put it back into that channel. And then lastly, I want to show you, I'll let you just screen capture this and play with it. This is the schematic number 2. Here is the Nasdaq Composite, which seems to have a family resemblance to that. This is the AD of the Nasdaq Composite. You can see the distribution or the lower highs across here, but now oversold, attempting to rally. This is a potential emerging bullish condition. If we can get non-confirmations like here, or potentially here to here, that would be very constructive. We will watch closely for that. Interesting place. Finally, I just want to make a comment about portfolio risk management. This is a very simple technique, and simple is good. And this is a weekly chart. In this case, I'm using Micron Tech just as an example. And as long as you have your price above a rising long-term moving average, you can pick the moving average that works best for you. It could be 150 days, 30 weeks, 200 days, whatever you like. But the key is a rising trend above a rising moving average confirmed by relative strength. So this is MU divided by SPX, where the same long-term moving average, it's above a rising relative strength moving average. So with both of these up, you have a positive confirmed bullish trend where the stock and the relative strength are in a leadership position. Excuse me. So once you get a break of this moving average here and here, that is a signal that the stock is no longer in a leadership position in the market, can result in a big, long, protracted downtrend or potentially a large trading range. And so here you could see that briefly, I'm very attracted to this structure right here. There's been a nice rally up. Now it may consolidate here and then start to rally again. But what we would want to see to confirm is a rising relative strength line above its moving average, rising price above its moving average. And if they're below, that is a sign of an emerging downtrend potentially. And so as a long-term portfolio position holder, you might consider that a fail-safe tool to get you out of stocks that could be bear market losers. And so simple tool, works extremely well. The addition of relative strength is very, very powerful. Okay, this is FedEx, just showing you, look at this distributional top. Distributions forming as the end of the uptrend is occurring. Relative strength breaks before the completion of distribution. And now you see a declining relative strength line below its long-term moving average. This is now confirmed with a turn down here and the moving average turning down on price. So they are now both confirming downward pressure. Look what happened for the next really nearly 2 years of downward trend for FedEx. And look at the relative strength, just confirm the underperformance, which is really demonstration that institutions are not in love with this stock or this theme because they are not contributing additional capital to this idea. As long as it's underperforming the market, it's not helping them with their performance. So then here, a return above the relative strength, returns above its rising moving average, price is above its rising moving average, and this is an indication that Wall Street is becoming enamored once again with FedEx, and then you can see that occurring here. Well, look what we have. The price is now just falling below its moving average right here, and relative strength is already in a downtrend. So institutions are likely being very cautious, possibly even raising some cash with FedEx. They'll never get out completely for the most part, but they will raise cash. So just a simple tool. It's a just a gut check for your positions in your portfolio if you're a long-term holder. And also I like to use it as a trend following tool and trend trading tool. So anyway, with that, I'm going to say goodbye. Thank you so much for being here. And thanks for staying on, hanging on a little longer. I love your feedback and your input and really appreciate you very much. And we'll see you next time.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.